Welcome to the deep dive. When you look at the market right now, it kind of feels like it's caught in this weird tug of war. On one side, you've got this almost euphoria, right? Indices hitting new highs, but then just below the surface, you hear a completely different story, a really cautious message. So how do you actually make sense of that? How do you get past the headlines and figure out what's really driving things for your own strategy? Well, that's what we do here at the deep dives. We take your sources, the research, the articles, your notes, and we sort of cut through all the noise. We pull out the key insights. It's basically your shortcut to being properly informed. Today, we're diving deep into a recent market analysis report. It's absolutely full of fresh data, expert takes. Our mission for you today is to try and clarify some of these opposing views, maybe shine a light on some tricky investing issues, and hopefully arm you with some clear advice, maybe a strategy for what might be coming next. Might even spark an aha moment or two. Okay, so let's get into it. The last 24 hours. Wow, a really significant market surge. I mean, the S&P 500 jumped over 1.1%, was at 6092.18. The Nasdaq climbed 1.4% to a new record, 19,912.53, and the Dow was up 1.19%. So it exactly lit the fire under everything.
Yeah, it's fascinating. The dominant catalyst seems pretty clear.
Yeah.
It was this wave of optimism about a potential ceasefire between Israel and Iran. That kind of geopolitical de-escalation. It just triggered a classic risk-on move.
Risk on, meaning money moving into growth stuff.
Exactly. Capital just rushed out of safer havens and poured into equities.
Yeah.
We saw huge flows into information technology, communication services, consumer discretionary. And at the same time, oil and defense stocks, which often benefit from tension, they dropped sharply. It was like the market just collectively decided to shed its geopolitical worry, for now at least.
Okay, but here's the rub, right? Amidst all that cheering, there's this really loud countersignal. What's the Federal Reserve telling us, and why does it seem like the market's just not listening?
That's the absolute core of the tension right now. The biggest piece of new info we've got is from Fed Chair Jerome Powell's testimony. That was June 24th. And he was, let's say, unequivocal in his caution. He stated very clearly the FOMC is, and I'm quoting here, well-positioned to wait to learn more about the likely course of the economy before considering any adjustments.
Wait and see. Basic.
Pretty much. And he specifically linked that waiting game to elevated uncertainty, especially around trade policy and potential tariffs. He wasn't shy about spelling out the risks they see. Now, before this testimony, the market consensus was kind of leaning towards maybe one, possibly two rate cuts late in 2025. But based on what Powell said, and also the recent inflation data we got, May CPI came in at 2.4% year over year, PPI at 2.6%. Both still stubbornly above that Fed 2% target.
Still sticky.
Right. So now the probability of what they call a hawkish hold, that's to jump to 55%.
Hawkish hold meaning no cuts anytime soon. Exactly. It means the Fed's likely keeping the federal funds rate right where it is, 4.25% to 4.50%, probably through July, maybe even into September. They're digging in their heels on inflation, and that directly contradicts this market party we just saw.
So, okay, big picture then. We've got this rally fueled by hopes of peace, geopolitical relief. But the Fed is standing over here waving this big red flag about the economy and inflation. What does that actually mean for you listening right now? It sounds fragile.
Fragile is exactly the right word. The key insight isn't just that the market's ignoring the Fed, it's the implication of that. It creates what we're calling a fragile rally. The market has basically chosen selective hearing for now. This surge isn't built on a, let's say, comprehensive look at all the signals, which means it's incredibly vulnerable. Any piece of news that shifts attention back to stubborn inflation or reminds everyone the Fed means business, well, that could reverse things quickly.
So upcoming data points are key then. Absolutely. Things like the June CPI report coming up on July 15th, or the next FOMC meeting on July 29th, 30th. These could be major triggers for volatility. A rapid pullback isn't out of the question. It's a bit like, enjoying the sunshine while ignoring the dark clouds building up.
Yeah, okay, that makes sense. So if that's the macro tension, how does this actually play out on the ground? Like with individual stocks, we've looked through the sources, found 5 specific names that really highlight these dynamics, each with its own story, right? Let's kick off with a giant. NVIDIA. NVDA. Always in the news. What's the deep dive telling us about its current state?
Well, with NVIDIA, you're talking a $3.5 trillion company. So its moves are really about huge institutional money flows. Ownership by institutions is massive, around 65.9%. Now, the big passive funds like Vanguard, they tend to hold steady. But we are seeing some signs that active managers and even CEO Jensen Huang have been trimming their positions a bit.
Profit taking after that incredible run.
Looks like it. Just some marginal selling. Short interest is tiny, so any real upward push has to come from genuine new buyers, not people covering shorts. And the options market. It suggests traders are expecting it to maybe trade in a range, say, between $140 and $150 in the very near term. So the core institutional backing seems solid, unwavering even, but there's a little bit of supply coming onto the market from that profit-taking. A steady ship, but maybe navigating slightly choppy waters near the highs.
Okay, from the steady giant to something quite different. Coinbase. Coinbase just saw a huge 12% pop. What on earth fueled that, especially in the crypto world?
Coinbase. That's a classic sentiment story playing out right now. The big spark was the U.S. Senate passing the Genius Act.
The stablecoin regulation bill.
Exactly. That piece of legislation provides a clearer regulatory path for stablecoins. And the market read that as a huge positive, basically lowering the barrier for big institutions to get more involved in crypto.
So market emotion just flipped from kind of nervous apprehension to outright optimism. That's what drove that initial price surge. Pure sentiment shift. But there's more to the Coinbase story now, isn't there? Our sources picked up on this new relative value idea. What's that about?
Yes, this is where it gets really interesting analytically. It connects to another company. Circle, ticker CRCL, they just had this explosive IPO. Circle is Coinbase's partner on the USDC stablecoin. Now, get this. Circle's market cap hit around $50 billion after its IPO. But Coinbase, which not only gets half the revenue from that same USDC stablecoin, but also has a much broader business, the exchange, custody services, everything else, its market cap is only around $87 billion.
Huh. So the argument is Coinbase looks cheap compared to its partner.
Precisely. This apparent valuation disconnect has created a really potent new bullish narrative. The idea is Coin might be fundamentally undervalued compared to Circle. In that kind of argument, it could attract a whole new type of investor, maybe arbitrage players looking to exploit that difference. That could give Coin more solid support beyond just the initial regulatory buzz. Just a small cautionary flag, though. We did see reports that Cathie Wood's ARK Invest was selling some CRCL shares. So something to keep an eye on, maybe a counter signal there.
Interesting. Okay, let's shift gears again. Five9, ticker FIVN. It's in that hot AI cloud software space, but the stock itself, it's been lagging, hasn't it? Our sources flag a major conflict here. What are the opposing forces?
Yeah, Five9 is a fascinating puzzle right now, a real analytical challenge because the signals are pulling in completely opposite directions. On one side, you have the technical picture, and frankly, it looks pretty bearish. The stock's trading around $26.59. That's way below its 200-day moving average, which is up near $32.76.
And below the 200-day usually signals a downtrend, right?
A long-term downtrend, exactly. And it's been making lower highs, later lows for months. So just looking at the chart, the path of least resistance seems, well, down. But then you look at the quantitative picture, the numbers behind the scenes, and it gets really intriguing, potentially quite bullish, actually. First, it has high short interest, 7.88 million shares shorted. That's about 4.4 days worth of average trading volume needed to cover those shorts. That's significant fuel for a potential short squeeze.
Okay, so lots of people betting against it.
Right. And then institutional ownership is incredibly high. Some reports put it between 79% and even over 100% of the available shares to float. Big names, major asset managers have been adding to their positions or starting new ones. Plus, Wall Street analysts. The consensus rating is a buy, and their average price target for the next 12 months is way up around $43, $44. That implies, what, over 60% upside from where it is now?
Wow. Okay, so the chart looks bad, but the institutions are buying, shorts are high, and analysts are bullish. How do you square that circle? Which signal wins out, especially in the short term, like the next 24 hours?
That's the million-dollar question, isn't it? For the very immediate term, our analysis tends to lean toward the technical view, the path of least resistance. Why? Because the stock doesn't really have a fresh, major news catalyst right now to suddenly break that downtrend. All those quantitative factors, the short interest, the institutional buying, that's like potential energy, it's a coiled spring.
Yeah.
But you need something to trigger it, right? An unexpected positive earnings surprise, a buyout rumor, something. So for now, that technical downtrend is probably the dominant force. However, and this is a big however, that high short interest makes it extremely sensitive. Any piece of unexpected good news could cause a really violent upward move.
So bearish for now, but watch out for sparks.
Exactly. It's in a kind of bearish balance, but a very fragile one. Highly vulnerable to being disrupted.
Okay, last one. BigBear.ai, ticker BBAI. This sounds like the definition of a speculative play. Jumped 25% recently.
Yeah.
What makes this kind of stock so different to analyze? And what's this paradox you mentioned?
Oh yeah, BBAI is pure narrative. Forget traditional fundamentals here. We're talking negative earnings per share, weak balance sheet. That's not what drives this stock. Its movement is all about probability and psychology. It's driven by retail investor FOMO, fear of missing out, combined with the determination of short sellers and how market makers hedge their positions. It ticks all the boxes for a short squeeze candidate. It's got this AI defense story attached to it, very high short interest, over 22% of the float, and tons of chatter on social media. Recipe for fireworks.
Okay, so where's the paradox?
The paradox is kind of ironic, actually. The very act of people jumping in, buying the stock, fueling this speculative frenzy that dramatically increases the chances that the company itself will turn around and announce a secondary equity offering.
Meaning they'll issue more shares to raise cash?
Exactly. They see the stock price spike, they need money.
Yeah.
It's the logical move for them. But issuing new shares dilutes the value for existing shareholders.
Yeah.
It almost always puts a cap on the rally, or even reverses it sharply.
So the fuel for the rally also creates the risk that kills it.
Precisely. It's a really key dynamic and a major risk when you're dealing with these lower quality, speculative, meme stock type names. Your own buying can inadvertently trigger the event that hurts your position.
Got it. Okay, so we've unpacked the big macro picture, the Fed versus the market. We've dived into these individual stock stories. Now, let's bring it home for the listener. How do you take all this insight and actually use it? What's the plan?
Right, because insight without action isn't that useful. Our analysis feeds directly into creating specific, actionable trading plans. The goal here is to enforce discipline, take the emotion out of it. So for each stock, we define clear triggers, what needs to happen to enter a trade. Confirmation signals, how do we know the trigger is valid? Price targets, where are we aiming? And crucially, stop-loss zones. Where do we cut our losses if we're wrong? For both bullish and bearish scenarios.
Okay, so based on that disciplined approach, which setups looked most compelling right now, say for the next 24 hours or so? What rose to the top?
Well, based on our scoring system, Carnival Corp, CCL, actually ranked #1. It got an 8.5 net advantage score.
Carnival. The cruise line. Why?
It had a really clean catalyst. Strong Q2 earnings beat expectations, and they raised their future guidance. That's a solid fundamental positive. And it was confirmed by a massive spike in trading volume. Our model gives it a 70% bullish probability in the near term, with a really attractive risk-reward ratio of 4-to-1.
So a plan there might be like, buy if it breaks above a recent high, watch the volume, target a level based on earnings momentum, and have a tight stop.
Exactly. Textbook breakout setup based on positive news. Coming in at #2 was actually BigBear.ai, BBAI, with an 8.0 score. Now, obviously, a very different beast.
Right, the speculative one.
Yeah, it scores high because of that extreme momentum and the huge short interest. Classic squeeze conditions. Bullish probability calculated at 60%, risk-reward around 3.5-to-1. But, and this is crucial, that plan has to incorporate the high risk of that dilutive offering we talked about. The stop loss needs to be potentially tighter, maybe triggered by news of an offering, or just if the momentum stalls, it's much more tactical, much more about risk management.
And Coinbase, you mentioned that was compelling too.
Yes. Coinbase also ranked highly. The key there is it has multiple catalysts still in play. The regulatory tailwind, those analyst upgrades are rolling in, and that circle valuation narrative is still developing. So there's ongoing fuel for momentum. And, all this really ties back to that initial point we made about the fragility of the geopolitical rally.
That the market ignored the Fed.
Right. It surged on one specific piece of good news, largely tuning out the Fed's clear caution. That makes the rally's foundation shaky. It's vulnerable to the next inflation print, the next Fed meeting. So the strategic takeaway, a tactical short-term trading approach probably makes more sense right now than making big long-term investment decisions based solely on this recent price surge. Be nimble.
We've definitely covered a lot of ground in this deep dive. That tug of war between the Fed and market sentiment, the really conflicting signals in a stock like FIVN, the unique risks baked into something like BigBear.ai. The goal, as always, is to give you the tools, the perspective to see beyond just the surface headlines and really grasp what's driving the market action.
And maybe it raises a question for you to think about. In this flood of information we all face, how much weight are you really giving to the conflicting signals? That critical thinking is so important, especially trying to spot those second, third-order effects of news. Often that's where the hidden risks, but also the hidden opportunities, lie. They aren't always obvious at first glance. The market isn't always perfectly logical, but understanding these forces definitely helps you navigate it better.
Absolutely. So if you found this deep dive valuable, if you want to stay ahead with the fastest, most frequent updates on these market shifts on specific stock plays, make sure you subscribe to the deep dive wherever you get your podcasts. It really is your shortcut to being well informed. Thanks for diving deep with us today. We'll be back soon with another deep dive, tackling your most pressing questions.